Hey everyone, welcome back to Corporate Decoder, the place where we dig into the sometimes boring but always important world of corporate filings. Today we're diving into Citizens and Northern Corporation's recent 10K report. Now, this isn't your average feel-good bedtime story for investors, but trust me, there are some interesting twists and turns, especially if you're into community banking. Think of it as a financial checkup, and we're here to read the results. Let's find out if this Pennsylvania-based bank is healthy or needs a bit of a financial boost. To start, we'll look at the business itself, then discuss risk factors. After that, we'll go over the key financial numbers to see how C&N did this past year and how it's looking financially. Citizens and Northern, or C&N, is a bank holding company. Think of them as the parent company of a bunch of smaller financial operations. Their main gig is community banking, primarily through Citizens and Northern Bank. But they also have some smaller parts to their business like Citizens and Northern Investment Corporation and Bucktail Life Insurance Company. The insurance part reinsures credit and mortgage life and accident and health insurance on behalf of C&N Bank. They've been expanding in Pennsylvania lately, acquiring other banks. In 2019 and 2020, they snagged Monument Bancorp and Covenant Financial. They also opened new branches, expanding into the south-central region of the state, namely Lancaster and York. All this expansion seems to be paying off. Their assets have grown quite a bit in recent years. C&N Bank offers a whole mix of banking services, from regular deposit and loan products for both personal and commercial customers, to wealth management services through their trust department and C&N Financial Services. The trust department handles things like 401k plans and estate planning, while C&N Financial Services offers insurance and investment products. Let's talk about people. C&N has about 386 employees, and they focus on attracting and keeping a diverse team, offering training, competitive pay, and a good work environment. Communication and engagement are also emphasized, which makes sense for a community bank. Now let's get to the risks, because there is no reward without risk. Like every bank, C&N faces many challenges that could impact their success. While I am not going to list them all in detail, it's useful to understand some of the biggest concerns. One key risk is related to their acquisition activity. Buying other banks can be tricky. There's always a chance of uncovering hidden problems or overpaying, not to mention the challenge of merging different operations. They want to keep expanding, but there's a risk they might not realize the benefits they expect from these deals. A big one for banks is credit risk. They have a lot of commercial real estate loans on their books. If their borrowers can't repay those loans because of the general economy or something specific to a property, C&N could take a hit. Banking regulators are also keeping a close eye on commercial real estate, so C&N needs to be extra careful managing that portfolio. Interest rates are a constant concern. The Federal Reserve's rate hikes can have a material adverse effect on the corporation's financial condition. Their assets are primarily long-term, fixed-rate loans and debt securities. Funding for these assets comes principally from deposits with no stated maturities, term deposits, and borrowed funds. Accordingly, there is an inherent risk of lower future earnings or decline in fair value of the corporation's financial instruments when interest rates change. Cybersecurity is also a major threat. The bank handles a lot of sensitive data, and a data breach could lead to big financial losses and reputational damage. C&N has invested in technologies and processes designed to protect the data, but it cannot guarantee a cyber incident will not occur. Let's change gears and talk about physical space. C&N operates 28 branch offices and a lending office plus a few administrative locations. Most of the properties are owned, but they also lease some. Moving on, C&N is currently tangled up in some legal proceedings, specifically a class action lawsuit related to a Ponzi scheme where one of the operators had accounts at the bank. Now C&N is fighting the suit, but these things can be unpredictable, and this matter remains pending. Now let's look at their stock and dividends. Shares of C&N are traded on the Nasdaq under the ticker symbol CZNC. The company also has a history of paying dividends, but future payouts depend on their financial health and regulatory rules. On the stock repurchase program, the corporation repurchased 26,034 shares at an average price of $17.02 per share. The report also charts the corporation's cumulative return to stockholders against the cumulative return of the Russell 2000 index and the corporation's peer group index. the Nasdaq Bank Index for the 5-year period. Now for the meat of the report. In 2024, C&N had a net income of roughly $26 million compared to $24 million in 2023. So net income increased a little over the previous year. However, the numbers for 2023 included a charge for repositioning some assets. Looking at their revenue, things get more interesting. Net interest income, which is basically the profit they make from loans, actually went down slightly, while they had to set aside more money for potential loan losses. That's setting aside about $2.2 million compared to much lower $186,000 the year before. On the other hand, non-interest income increased thanks to things like brokerage and trust revenue and from selling mortgage loans. Now let's dig into their risk factors again. The corporation grants commercial, residential, and personal loans to customers primarily in the corporation's markets of the northern tier/north central regions of Pennsylvania, southern tier of New York, and southeastern and south central Pennsylvania. A significant portion of its debtors' ability to honor their contracts is dependent on the local economic conditions within these regions. Speaking of risks, cybersecurity is a big deal. It also includes exposure to failures or interruptions of service or security breaches resulting from malicious technological attacks that impact the confidentiality, integrity, or availability of our or third parties' operations, systems, or data. It seems the board and the Information Security Department is working to do everything they can to prevent that. Digging into those numbers, interest income totaled $128.9 million. Also, average loans outstanding increased by almost $90 million, meaning there was a net positive effect on the company, and people and corporations were borrowing. What about the actual percentages on the interest? The corporation experienced growth in outstanding commercial real estate and residential mortgage loans over the last 3 quarters of 2022 and in 2023. Interest rate spread, the difference between their income and the cost of funds, decreased from 2.91% to 2.59%. This indicates they are seeing increases in the rates they pay out to their clients, outpacing any increases on rates charged. Moving on to non-interest income, trust revenue of almost $8 million increased thanks to new business. Brokerage and insurance revenue also had a bump, increasing due to higher sales volume. Non-interest expense, the general cost to keep the operation running, also changed. While professional fees went down due to fewer conversion costs, salaries and employee benefits increased. The corporation's effective tax rate decreased from 20.8% to 18.6% between 2023 and 2024. Tax-exempt interest income and income from BOLI contributed to the effective rate being lower than the federal statutory rate in 2022 through 2024. The total outstanding balance of loans the corporation has repurchased as a result of identified instances of noncompliance amounted to $2,671,000, but no allowances have been established to address this. The MPF Extra and MPF Original Program guidelines for origination, underwriting, and servicing loans may force forced repurchases or being dropped from the program. Finally, the cybersecurity team has to review their incident response plan annually to be ready to deploy if anything happens to them. It is all managed by the incident response team, which includes the Director of Information Security, Chief Risk Management Officer, Chief Information Officer, and other essential members of management. Realization of deferred tax assets ultimately depends on the existence of sufficient taxable income, including taxable income in prior carryback years, as well as future taxable income. The corporation owns common stock of the FHLB Pittsburgh. Such risks affecting the FHLB Pittsburgh could adversely impact the value of the corporation's investment in the common stock of the FHLB Pittsburgh and/or affect its access to credit. There was an application for certification of the suit as a class action. The corporation does not believe that a loss is probable in this matter, nor can a range of possible losses be determined, and accordingly, no liability has been recorded for this litigation matter in the accompanying consolidated financial statements. As a general idea of the risk the assets hold, the market yield on the 5-year U.S. Treasury note was 0.54% higher in comparison to December 31, 2023, and 0.39% higher than at December 31, 2022. Net interest income varies by 2.1% lower and 17.4% in the low and high extremes. The overall equity present value is lower as well, signifying a less advantageous climate. So what's the story here? C and N seems to be doing alright, but they need to be aware of external forces and conditions. Their expansion strategy has proven successful, but they need to watch the real estate climate and potential fallbacks. Thanks for watching. If you thought this video was helpful, please like, subscribe, and comment, and let me know what corporation we should decode next.